You ever wonder why a stock tanks the moment new shares hit the market? A lot of the time, it's because of PIPE investors. But here's what most people don't understand. PIPE investors aren't just some mysterious group manipulating stocks. They're a specific mechanism that companies use to raise capital fast. And if you don't understand how PIPE deals work, you're missing a critical piece of the puzzle when analyzing why certain stocks move the way they do. I'll be breaking down exactly what PIPE investors are, how these deals are structured, and why they create the kind of price pressure that can catch unprepared investors off guard. This is important information that'll change how you evaluate stocks going forward. Okay, so PIPE stands for Private Investment in Public Equity. I know, that sounds super boring, but let me break it down. A PIPE is when a public company, like a company that's already trading on the stock market, sells shares directly to a big investor. And they do it privately, not on the open market, not through your broker, just one-on-one behind closed doors. And here's the thing, they usually sell those shares at a discount. Like imagine you're buying concert tickets, but instead of paying full price on Ticketmaster, you know the band's manager and you get them for 30% off. That's basically what's happening here. The big investor gets a deal the rest of us don't. Pretty cool, right? Well, cool for them. Not always cool for you and me. So why would a company do this? Why not just sell shares the normal way? Well, because PIPE deals are fast, like really fast. If a company needs cash right now, maybe they're running out of money, maybe they want to expand quickly, maybe they're trying to survive. They don't have time to go through the whole song and dance of a public offering. That process takes months. It's expensive, there's paperwork, lawyers, bankers, all that. A PIPE, you can close that deal in weeks. Maybe even days. So companies use PIPEs when they need money yesterday. The stock market doesn't care about them enough to buy shares at full price. They're too small for the big banks to even bother with. It's basically the express lane for raising cash. Now, who are these PIPE investors? Who's got the kind of money to do this? Usually it's hedge funds, private equity firms, mutual funds. Sometimes it's just super rich people who meet the legal definition of accredited investor. And every now and then it's a strategic partner, like another company that wants to help this one grow because it benefits them too. These aren't regular people like you and me. These are players with millions, sometimes billions, to throw around. And because they're taking a risk by giving the company fast cash, they get special terms we don't get. You see where this is going? Let me break down what PIPE investors actually get, because this is where things get interesting. First, they get a discounted price. Like I said earlier, if the stock is trading at $10, they might pay $6 or $7. Instant deal. Second, the shares are usually restricted. That means they can't just turn around and sell them tomorrow. There's usually a lockup period. Could be a few months, could be longer. Third, they often get warrants. Think of warrants like coupons. They give the investor the right to buy even more shares later at a set price. So if the stock goes up, they can cash in again. And if you want a real example of how warrants work, I did a full breakdown in my open door video. It shows exactly how these things hit the market. Sometimes instead of shares, they get convertible debt. That's basically a loan that can turn into stock later. And the terms on those, usually pretty sweet for the investor. So why do they get all this? Because they're giving the company money now when the company really needs it. So the company says, okay, we'll make it worth your while. Here's how the whole thing works, step by step. The company and the investor sit down. They negotiate. They agree on a price, how many shares, what kind of perks the investor gets, all that stuff. The investor agrees to buy, done deal, cash in the bank. But here's the thing, the shares are restricted. The investor can't sell them right away. So the company files something called a resale registration with the SEC. That's basically asking for permission so the investor can sell later. Once that's approved and the lockup period ends, those shares can hit the open market. And that's when things can get messy. Because here's the problem. When those PIPE shares unlock, there's suddenly a flood of new shares out there, more supply. And if there's more supply, but the same amount of demand, what happens to the price? It drops. Think of it like concert tickets again. If 10,000 people want tickets and there's only 5,000 available, prices go up. But if suddenly 20,000 tickets appear, price crashes. Plus, remember, these investors bought at a discount. If they paid $6 and the stock is now at $10, they can sell and make a quick profit. Even if the stock drops to $8, they're still winning. But regular shareholders, not so much. So when you hear people say PIPE investors dump their shares, this is what they mean. The lockup ended, the investors cashed out, and the stock price tanked. It's selling pressure, and it can be brutal. Okay, but if PIPE deals can hurt the stock, why do companies keep doing them? Well, because sometimes you gotta do what you gotta do. If the company is about to run out of cash, a PIPE deal might be the only option. It's faster than waiting for a public offering. It's easier than begging a bank for a loan. And for small companies, especially ones that are growing fast or trying to turn things around, it's a lifeline. You see this a lot with small caps, startups, SPACs. These are companies that don't have big, stable cash flows yet. They need outside money to survive and grow, and PIPE deals are one of the best ways to get it. So yeah, it might dilute the stock, it might scare some investors, but if the alternative is going bankrupt, the company's gonna take the PIPE deal every single time. And speaking of SPACs, quick side quest here, because PIPEs show up a lot in SPAC deals. When a SPAC announces it's merging with a company, they usually line up PIPE investors at the same time. Why? Because the PIPE money is like a vote of confidence. It shows, hey, real investors are putting real money into this deal. But, and this is a big but, if the merger doesn't go well, those PIPE investors can turn around and dump their shares once the lockup period ends. And because SPAC stocks are already super volatile, that selling can absolutely crush the price. So if you're ever looking at a SPAC, check if there's a PIPE involved, and definitely check when that lockup period ends, because that's when the fireworks usually start. Let me give you a quick example. Not financial advice, just showing you how this works. Imagine company X needs $50 million. They're a small biotech startup, stocks trading at $10, but they can't wait months for a public offering because they need to fund a clinical trial, like now. So they do a PIPE deal. They sell 10 million shares to a hedge fund at $5 each. Boom, $50 million raised. The stock drops a bit when the deal is announced because investors know dilution is coming, but the company gets the cash. They fund the trial. Everything's fine. 6 months later, the lockup ends. The hedge fund starts selling. They paid $5. The stock is now at $8, so they're making bank. But all that selling creates pressure. The stock drops to $6. Regular shareholders are mad. They can't stomach the drawdown and sell off even at a loss. The hedge fund walks away happy. That's the cycle, and it happens all the time. Now, are there any upsides to PIPE deals? Actually, yeah. For the company, it's fast money. It keeps the lights on. It can fund growth. And sometimes the PIPE investor isn't just money, they're a strategic partner who brings connections, expertise, or credibility. For investors watching the stock, a PIPE can be a sign that someone with deep pockets believes in the company. If a big-name fund is willing to write a check, that's not nothing. So PIPE deals aren't automatically bad, but they do come with risks. Let's talk about the downsides though, because they're real. First, dilution. More shares means your slice of the pie gets smaller. Second, selling pressure. When the lockup ends, there's a real risk those investors dump their shares. Third, perception. When a company announces a PIPE deal, some investors see it as a red flag. Like, why do they need cash so badly? Are they in trouble? And fourth, the stock can tank just from the announcement because experienced traders know what's coming. So how do you spot PIPE activity if you're watching a stock? Check the SEC filings. Look for an 8K. That's the form companies file when something major happens. If there's a PIPE deal, it'll be in there. Also, look for terms like private placement, resale registration, convertible notes, or warrants. Those are all clues. And pay attention to lockup dates. If you know when the PIPE shares unlock, you can prepare for potential selling pressure. So when do PIPE deals matter the most? Low float stocks. If a stock doesn't have many shares available to trade, adding a bunch of PIPE shares can flood the market. SPAC deals. Like I said earlier, PIPEs and SPACs go hand in hand. Companies running low on cash. If the balance sheet's looking rough, a PIPE might be their only option. And for small companies, penny stocks, high volatility, small market cap, PIPE deals can move the needle big time. But here's the thing, not every PIPE is bad. Sometimes the investor's in it for the long haul. Sometimes they believe in the company and aren't just looking to flip shares for a quick buck. Sometimes the PIPE actually helps the stock because it funds something that makes the company way more valuable. So don't automatically freak out if you see a PIPE deal. Just be aware, know the terms, know when the lockup ends, and make your own call. If you're investing in small caps, SPACs, or anything volatile, keep an eye on PIPE deals. They're part of the landscape, and understanding them, that's how you avoid getting blindsided. And hey, I hope this video helps you on your quest for profits.